Good day, everyone. Today, we are going to discuss an essential aspect of mergers and acquisition with respect to transfer pricing. Now, transfer pricing plays a pivotal role in determining how intercompany transactions, assets, and liabilities are valued between acquiring and target companies. Ensuring that these transactions are compliant with the arm's length principle is critical to mitigating tax risk and complying with local and international tax regulations. In this module, we'll be looking at Module 24, Transfer Pricing in Mergers and Acquisition. The arm's length principle requires that transactions between related parties are priced as though they were conducted between independent entities. In mergers and acquisition, accurate valuation and pricing of assets, liabilities, and intercompany transactions help minimize tax disputes and ensure a seamless post-acquisition integration. So during this session, we will cover valuation and pricing strategies, compliance requirements, case studies demonstrating transfer pricing in mergers and acquisition. So let us begin by discussing how to approach valuation and pricing during mergers and acquisition. So transfer pricing in merger and acquisition involves assessing the fair market value of tangible and intangible assets while ensuring that all intercompany transactions comply with the arm's length principle. This valuation process is crucial to avoid potential tax disputes, penalties, and to ensure regulatory compliance. Now let's look at the key consideration in M&A transfer pricing. We have the pre-acquisition valuation. Before an acquisition, one of the first steps is to conduct thorough due diligence to assess the target company's assets. And this includes tangible assets such as machinery, real estate, and inventory, intangible assets such as intellectual property, trademarks, patents, goodwill, and proprietary technology. Now let's move to valuation method. Choosing the right valuation method is critical, and the three main methods are comparable uncontrolled price method. This method compares the pricing of intercompany transactions with similar transactions between independent entities. Discounted cash flow analysis. This method estimates the present value of future cash flows generated by the assets or business. Market comparables. This approach uses market data from similar transactions to benchmark the value of assets or business units. Now, special focus on intangible assets. Intangible assets such as patents. Okay, I'm going to take that again. We're looking at intangible asset now. Intangible assets such as patents, trademarks, and goodwill can be particularly challenging to value, but are often critical to the overall acquisition price. It is essential to ensure that these are properly valued as they can significantly impact the success of the transaction. Now, intercompany transaction, I haven't looked at the pre-acquisition valuation. We're not looking at the intercompany transaction. Now, under post-acquisition, it is important to revisit and potentially revalue intercompany transactions to ensure they comply with the arm's length principle. So let us consider reviewing the target company's existing transfer pricing policies for intercompany transactions, such as cross-border financing, service agreements, and royalties. Now, ensuring these policies are aligned with the acquirer's policies post-acquisition. Now let's look at post-acquisition. Post-acquisition is it is crucial to ensure a smooth integration of transfer pricing policies between the acquirer and the target company. So it is very essential to ensure a smooth integration of that. So the key step in post-acquisition integration is one, harmonizing policies. The acquirer and target companies' transfer pricing policies need to be aligned to avoid inconsistency. Now, the cost sharing and synergies. Evaluate potential synergies post-acquisition. For instance, consider shared services, economic of scale, or joint research and development collaboration. This can lead to cost savings and should be accurately documented in transfer pricing policies. Now, on valuation method, let's take a closer look at the three primary valuation methods used during mergers and acquisition or during an M&A transactions. Comparable uncontrolled price method. This method compares the prices of intercompany transactions with similar transactions between independent parties. It is particularly effective for pricing goods, services, and intangible assets when comparable market data is available. The discounted cash flow analysis. The discounted cash flow analysis method estimates the present value of future cash flows expected to be generated by the assets, business unit, or the entire target company. It is commonly used to value intangible assets such as patents, proprietary technologies, or goodwill. With respect to market comparables, this method uses data from similar transactions or companies in the industry to benchmark asset valuations or business unit price. Market comparables are useful for cross-referencing the result from other valuation methods, ensuring accuracy and fairness in pricing. So let's look at compliance considerations for mergers and acquisition. Now, ensuring compliance with transfer pricing regulations is critical during M&A to mitigate tax risk and avoid costly disputes with tax authorities. Proper documentation, thorough analysis, and adherence to transfer pricing guidelines are essential to demonstrate that intercompany transactions reflect the arm's length principle. Now, let's look at the key compliance requirements. Transfer pricing documentation. We look at the pre-acquisition. During the due diligence process, it is essential to document the following: the valuation method used, key assumptions made during the valuation, findings that support the transfer pricing positions. This documentation listed above provide the basis for defending any future tax challenges and ensure that valuations are in line with regulatory expectation. That is for pre-acquisition. Now, for post-acquisition, once the acquisition is completed, transfer pricing documentation must be updated to reflect changes in intercompany transactions, transfer pricing policies between the acquirer and target company, master file and local file. Maintain both master file and local file documentation, and the master file should include a global overview of the business and its transfer pricing policies. The local file should maintain and should contain jurisdiction-specific information on intercompany transactions. Now to the functional and economic analysis. A detailed functional analysis must be conducted to assess the roles of each entity in the transaction, including functions performed, what roles do the entities play in generating value, asset use, what resources are employed in the business operations, risk assumed, what or which entity bears the most risk. Additionally, perform an economic analysis to ensure that the valuation and pricing of intercompany transactions align with market conditions and industry practices. So let's look at intercompany agreement. For post-acquisition, intercompany agreements should be updated to reflect new pricing arrangements, terms and conditions. This ensures that transactions remain consistent with both the company's transfer pricing policies and regulatory requirements. On regulatory compliance, it is critical to adhere to both local and international transfer pricing regulations, including the OECD transfer pricing guidelines, base erosion and profit shifting BEPS action plans, and by proactively engaging with tax authorities during the mergers and acquisition process, companies can clarify compliance issues and reduce the likelihood of tax disputes post-acquisition. Now, for best practices for compliance, proactive communication, like we always say, you need to engage with tax authorities early in the M&A process to clarify transfer pricing regulatory requirements and obtain guidance on compliance. So it is important to inform them and to also engage them. Consistent documentation, ensure that all transfer pricing documentation is consistent and reflect the economic substance of the transactions. And then conduct regular reviews of transfer pricing policies and documentation to ensure ongoing compliance. Address any changes in business operation or regulatory environment as needed. With respect to case studies on transfer pricing in M&A. So let's now discuss a few case studies that illustrate how transfer pricing is applied during mergers and acquisition. So with respect to valuation of intangible assets in a technology acquisition, XYZ Tech Company, a multinational technology company, acquires a smaller tech firm specializing in software development. The acquisition involves significant intangible assets, including proprietary software and patents. Now, for the implementation, XYZ Tech Limited uses discounted cash flow analysis to value the proprietary software and patents. Future cash flows expected from these assets are estimated, and an appropriate discount rate is applied to calculate present value. Now, with respect to due diligence, the company conducts thorough due diligence to assess the fair market value of the intangible assets and ensure that their valuation adheres to the arm's length principle. With respect to documentation, comprehensive documentation is prepared, including the discounted cash flow analysis, key assumption, and findings to support the valuation. Definitely, the outcome is accurate valuation. The DCF analysis or the discounted flow analysis provides an accurate valuation of the intangible assets, reflecting their expected future economic benefits. On regulatory compliance, the detailed documentation ensure compliance with transfer pricing regulation and support the company's position in the event of an audit. Now, case study 2 is harmonizing transfer pricing policies post-acquisition. So now, with respect to post-acquisition, harmonizing transfer pricing policies post-acquisition. So ABC Manufacturing Limited, now a manufacturing company, acquires DEF Industry, a competitor in the same industry. So post-acquisition, the challenge is to harmonize transfer pricing policies between the two. Now, how did they implement this? One, the first thing they do is to review existing policies. ABC Manufacturing Limited reviews DEF Industries' existing transfer pricing policies and intercompany agreements to identify any inconsistency. Now, having done that, having reviewed the existing policies, the next thing is to do policy harmonization. Transfer pricing policies between the two companies are harmonized, ensuring that documentation practices are aligned and consistent across the group. With respect to cost sharing arrangements, the merged company evaluates potential cost sharing arrangements and synergies, documenting cost savings and benefits arising from the merger. On outcome, there is an efficient integration, because harmonizing transfer pricing policies ensure a smooth integration of the acquired company, minimizing disruption to business operations. With respect to compliance assurance, the updated and consistent documentation ensures compliance with transfer pricing regulations and reduces the risk of tax disputes. With respect to that, you can see that the outcome was positive. Now, let's look at case study 3. In this case, we are looking at LMN Pharmaceutical Company, a multinational pharmaceutical company, merges with GHI Biotech to expand its product portfolio. The merger involves significant intercompany financing arrangement between the two entities. With respect to implementation, LMN Pharma uses the comparable uncontrolled price method to price the intercompany loans and guarantees provided to the merged entity. Economic analysis. An economic analysis is conducted to assess the terms of the financing arrangement and ensure they reflect market condition. With respect to documentation, comprehensive documentation is prepared, including intercompany agreements, functional analysis, and benchmarking studies. Now, the outcome of this is that there is an accurate pricing. The COP method ensures that the pricing of intercompany financing arrangement reflects the arm's length principle. With respect to regulatory compliance, detailed documentation supports compliance with transfer pricing regulations and prepares the company for potential audits. So we've looked at 3 case studies now to illustrate transfer pricing in mergers and acquisition. So in conclusion, transfer pricing in mergers and acquisition is a complex but essential process for ensuring compliance with tax regulations. Now, the proper valuation of assets, especially intangible assets, pricing of intercompany transactions, and thorough documentation are critical to minimizing tax risk and ensuring smooth integration post-acquisition. The key takeaway here is use valuation methods such as the COP method, the discounted cash flow method, and market comparables to ensure accurate asset valuation. Now, maintain consistent and detailed documentation throughout the mergers and acquisition process. Engage proactively with tax authorities and ensure that all intercompany transactions adhere to the arm's length principle. So by following these best practices, companies can effectively manage transfer pricing during mergers and acquisition transactions, ensuring compliance and minimizing tax risks. Thank you for your attention.